Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to take a quick look at the capital markets activity as venture capital investments nearly doubled in 2019, but overall deals declined. And we're seeing in California that there's a struggle with financial woes. Some of these smaller firms are turning opportunities to smaller investors in a tight funding climate. Cannabis farm in Washington just got nailed with a Ponzi scheme. There's a federal complaint. And even Hollywood celebs can't keep their money safe in a mattress. Apparently, Leonardo DiCaprio and rapper 50 Cent have been the latest smart money investors to feel the pain of plunging valuations after their investment in Casper Sleep, an online mattress retailer, saw valuations fall as it attempts to IPO. Very reminiscent of WeWork with these crazy valuations, and then as they try to sell that to the public, it doesn't work out, and then their valuations crumble. But we're seeing 3 years in a row where the venture capital funding is declining. A lot of funds have actually closed because it's just too crazy. We're seeing valuations in the private market currently under a microscope, especially with unicorns as they attempt to tap the public markets, a unicorn being a market cap of $1 billion. The global IPO markets also slowed to a 3-year low. Even the returns on our AI-based algorithm, we have an artificial intelligence-based trading robot, if you will, and our 3-year average is 42%, but it's been declining because it's been harder and harder to get, from a technical analysis standpoint, higher returns. The market's just been getting crazier and crazier, and so those margins are being squeezed, but we're still doing really well, up 20%. Next best competitor is -5. So if you're an accredited investor, let me know. This Forbes article goes on to say that even though the overall numbers of deals declined in the cannabis space over 2019 when compared to the previous year, venture capital investments nearly doubled. The firm's PitchBook-powered data reveals that 2019 saw 307 deals across 277 cannabis-related companies, totaling approximately $2.6 billion in venture capital investments at a median deal size of $2.5 million and a median post-money valuation of $20 million. According to the CEO of Elo Capital, they're seeing big institutional investors now buying into cannabis, and other investors are taking notice. While these financial moves alone signal a cannabis milestone is just the beginning, other institutional giants are watching and monitoring legislation like the Safe Banking Act, which could open the door for more substantial cash flow. As we look towards 2020, we can expect even more aggressive players to enter the space, particularly in the US. So what does this trend of increasing venture capital mean for the future of cannabis? US capital is dominating the sector as the largest funding source for cannabis worldwide. While cannabis investments are coming from all over the world, most cash from the top deal makers continue to originate in the US. The leading firms investing in the space and the amount of deals they funded in 2019 are Philo Partners with 23 deals, beside an asset management at 21, and the Entourage Effect Capital at 20 deals. Despite the venture capital excitement, 2020 will likely present its own challenges. There will always be some IPO activity, including reverse takeovers. The industry will probably not see a return to the level of activity seen in 2018, at the very least, until the US exchanges open up to US-based plant-touching businesses. As it's related to deal flow in 2020, any externalities such as significant reductions in valuations, increased regulatory scrutiny, increased focus by investors on operational issues, it can change the economics or strategic value of a transaction, increasing the risk it will not be closed. For this reason, it's more important now than ever before to truly grasp the complex cannabis financial ecosystem and better understand which deals are set up for success. We've seen a lot of deals unwind, and then some companies just outright selling their assets in certain regions and reevaluating what they're doing. So I don't doubt that that's going to continue to be a trend as companies look to kind of liquidate certain regions like Kansas that they don't want. I think Forefront ended up selling off their assets in Kansas. And then, with MedMen, their whole issue, I don't even know if they're going to be able to survive to try and correct any potential commercial real estate dip. They're already on the mend. California, having just regulated their marketplace, is already struggling. Huge marketplace there. This article from MJ Business Daily says that the licensed California cannabis companies face a business climate that's arguably more dire than ever before, despite the hope that came with the launch of the legalized adult use in January of 2018. Many feel they're on a death watch of sorts, waiting to hear about more layoffs or company closures stemming from the chaotic mix of high taxes, lack of local buy-ins, high barriers to entry, skyrocketing compliance costs, and unforeseen complications, including vape crisis. Actually, those should all have been seen. You have to kind of plan for the unplanned. This is going to be a volatile industry, no doubt. So those difficulties led to a trend of many licensed companies struggling to pay their business partners and vendors for inventory they've already stocked or service received because they're strapped for cash. And while California remains the largest marijuana industry in the world with nearly $3 billion in sales in 2019 alone, an estimated 80% of the transactions still take place in the underground market, according to a report by Boulder, Colorado-based BDS Analytics and San Francisco-based ArcView Market Research. After layoffs at both large and small companies up and down the supply chain, which included MedMen, Pax Labs, Canacraft, Grupo, Floor, and others, the reported services that many businesses are delinquent in paying their bills. So the industry could see a bloodbath in 2020 unless California officials take drastic action to alleviate financial pressure on legal businesses, whether through tax relief, the opening of more legal retail outlets, or other options. There are a lot of companies looking for capital, including publicly traded companies. There's been a lot of money that went into the industry, like the ETFMG Alternative Harvest Index. They saw $1 billion in assets under management. It's lost about 20%. But there's still a lot of money out there. And so for smaller firms, a lot of that is becoming dried up. Investors that have lost money in 2019 are off to the sidelines or not liquid, don't have enough capital to put in. You're seeing a lot of cannabis firms looking to smaller investors in a tightening climate for lending. High Times is a pretty good example of a company that had a lot of optimism, which didn't quite work out. They tried to file a Regulation A, which is an exemption to Rule 144A, which limits companies from selling stock or equity in companies to the general public. Rule 144A limits you to 35 non-accredited investors a year, meaning you need to make $250,000 or have $1 million in liquid assets to qualify for investing. But Regulation A didn't help High Times. The public just didn't believe in the $100 million debt they have. And so that's sort of collapsed. Not really sure what they're going to be doing now. They're going to try and do brick and mortars. I'm not sure that's going to work out. We'll see. Conceptually, it's kind of like peer-to-peer lending, where you can kind of go out and just solicit to anybody and not worry about SEC rules, regulations, compliance costs, which for some of these companies that have gone public and now their stock price is 40 cents, it's not worth the compliance cost to be publicly traded. So it is kind of interesting seeing a lot of these decks, which are more promotional PR things rather than true investment decks. I just find it interesting where you could definitely feel, no matter where you're at, California or Canada, everywhere in between, it is becoming more and more tight. And that's because a lot of people got burned either on the stock market. In 2019, we saw Fibonacci retracement of over 60% for a lot of those indexes. Individual securities got hammered even more than that. And so with a lot of those people that just bought and held are still waiting for that to come back up. Other people that sold are on the sidelines thinking that the low hasn't hit, that maybe zero is the bottom, and those companies will just go out of business. Their break-even point is over $1.60 per gram. So it's just a matter of time before that happens. So being a trader, you can kind of get in and get out. But a lot of people got burned. Case in point, there's a federal complaint. This is in the Seattle PI, where their cannabis farm here locally was used as a Ponzi scheme. So an individual in Anacortes, that's near the Canadian border, ended up selling securities or equity in their business, in their pot farm, telling them that it was going to be for this cryogenic machine that was going to make $1 million a month in product. And it just went towards a Bentley Continental, a Porsche Cayenne, and then some yacht, right? So if you're a cannabis farmer or any farmer and you're driving a Lambo, if you did a friends and family around, someone's going to see that, someone's going to notice. And so obviously that's what happened. There was a complaint filed in California by an investor who knew that something wasn't up. And so, it just takes a few of these for people to take a step back and say, okay, this is a commodity. Farmers aren't going to get rich. And if some guy's driving a Lambo or a Bentley Continental, there's something that's up with that. So hopefully they'll weed these people out, and then the legitimate farmers by fourth quarter maybe will start to gain more market share. So that's some of the predictions that we're seeing is fourth quarter. There'll be a huge squeeze as some of these companies go out of business or just give up second and third quarter, with the fourth quarter being a huge pop for those that are still remaining or left standing. We'll just have to see. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.